Imagine being handed 2 cups of tea, one brewed from leaves costing a modest $10, the other from a rare harvest priced at $1,000. Could the difference be tasted? Most would wager not. Back in 2001, a curious experiment unfolded at a French university, shaking the foundations of the beverage world. A researcher, Jacques Moreau, gathered 57 tea connoisseurs to sample 2 blends, one dark and robust, the other light and delicate. The tasters swirled, sniffed, and sipped, describing the dark tea as bold, earthy, and complex, terms often reserved for richer blends. The light tea earned praise as crisp, airy, and fragrant. Yet, the twist was startling. Both cups held the same tea. Even more astonishing, the dark tea was merely the light one tinted with a harmless dye. Not one of these seasoned experts caught the ruse. Pause and ponder that. 57 authorities couldn't distinguish between identical brews. This tale unveils a broader truth worth exploring. The reverence for expertise often overshadows its limits. Society tends to place unwavering trust in those adorned with titles and credentials. A pilot's steady hand at the helm of a jet inspires confidence. A physician's prescription carries an air of certainty. Legal advisors are leaned on to navigate thorny disputes, while media commentators are devoured for their insights. Expertise, after all, is seen as a product of years spent honing skills, something to be rewarded handsomely. Few would entrust a novice to construct a bridge or mend a broken bone. From childhood, deference to specialists is ingrained: educators, healers, financial gurus. But the crux lies in outcomes. A wall of diplomas means little if the promised results falter. Despite a cultural obsession with expert guidance, the scorecard in areas like personal finance reveals a sobering picture. Financial literacy scores paint a grim scene. In 2008, teenagers averaged a mere 48% on a national assessment, while young adults barely cleared 65%. Investing is often reduced to a game of hunches, chasing the next hot tip rather than building wealth through discipline. Debt burdens most households, and even the titans of finance stumble in managing their own risks. Something's awry when the supposed sages fall short. The lesson rings clear. Expertise must be judged by what it delivers. Navigating the investment landscape can feel like wandering a labyrinth. Stocks of all sizes, real estate trusts, bonds, and a dizzying array of funds, each with its own costs and quirks. It's tempting to hand the reins to a professional and ask, "Can't someone else sort this out?" Yet here's the rub. Those heralded as financial wizards, fund overseers, and market prognosticators frequently fare no better than novices. Often they lag behind. A young adult with a modest sum can outpace these masters by steering their own ship, opting for straightforward low-fee funds without intermediaries. The notion of financial expertise, for the everyday person, proves more illusion than reality. Why does this gap persist? Several threads unravel the mystery, but the invitation here is to question the pedestal on which specialists stand. Are their fees, sometimes draining thousands, justified? What bar should their performance clear? Wealth, in truth, hinges less on external saviors and more on personal resolve. It boils down to what's saved and how it's grown over time. Embracing this demands courage, for it strips away scapegoats. No advisors to fault, no complex schemes to hide behind, no market whims to curse. Yet it also empowers, placing the trajectory of prosperity firmly in hand. The joy lies in upending expectations. Skeptics may scoff, insisting their chosen guides or pricey funds defy the odds. Returns might dazzle on paper, but peel back the layers: taxes, fees, and the shine often fades. The assumption endures. High gains must validate the cost, or do they? The path forward sidesteps the clamor of so-called expertise. It leans on evidence, not fanfare, proving that simplicity can triumph. A steady hand, armed with low-cost, diversified investments, can outstrip the market's loudest voices. Doubt may linger, but the numbers hold firm, a quiet revolution against the myth of mastery. Unmasking the market oracles. Before charting the course to self-reliance, consider the machinery behind expert advice. The most prominent voices: Pundits and fund stewards thrive on bold forecasts. Markets will soar or plummet based on whispers of trade winds or distant tremors. This dance of prediction, dubbed market timing, captivates audiences. Yet, the reality bites. No crystal ball reveals the market's next move. Daily queries flood in. Thoughts on commodities, currencies, tech giants. But the honest answer is a shrug. Short-term foresight eludes all, despite the confident chatter. Filling screens, media feasts on every ripple. One day, dire warnings accompany a sharp drop. The next, euphoria greets a rebound. It's a spectacle, but what's gained? A barrage of noise drowns out clarity, nudging impulsive moves over steady strategy. The takeaway: tune out the seers. Their guesses lack substance. Even fund custodians succumb to the hype, chasing fleeting trends with frequent trades, racking up costs and tax burdens, all to flaunt short-term wins. Their reward? Staggering paychecks like the $600,000 average haul at a top-tier firm in 2006. Yet, 3/4 of the time, they fail to best the market's humbler pace. Past glories, a fund spiking 80% over 2 years, offer no guarantee. Rewind to 2000, the top performers then rarely held their crown years prior. Name the decade's stars. Perhaps a tech darling comes to mind? But what of obscure victors like a trucking firm or a biotech sleeper? No one consistently picks the winners. Claims otherwise are smoke and mirrors. Despite lavish rewards, fund stewards trail the market 75% of the time. So dismiss the hype. A fund's recent sprint means little. Only a decade-long record reveals its mettle. Short-term dazzle fades against the grind of fees and the sheer odds of outpacing a vast, unpredictable beast. The art of concealment. Experts don't just falter, they cloak their missteps. The financial realm excels at this sleight of hand. Rarely do they own their errors. Studies, like one cited by analyst Clara Hensley, expose rating agencies lauding firms even as they teetered on collapse. Nearly all stuck to buy or hold calls until bankruptcy loomed, some even on the filing day itself. Star ratings, those gleaming badges of trust, prove hollow. Research from 1999 found low marks signaled duds, but high praise didn't assure victors. 5 stars dazzled, yet often failed to outshine the middling pack. Then there's the shell game of incubator funds. Launch a dozen, tout the few that thrive, and bury the rest. Survivorship bias polishes the illusion. Only the living funds strut the stage, masking the graveyard of flops. A top 10 funds list shines bright, but the shadows hide the full tale. These tactics thrive on trust. A glossy roster of 15% returns, stamped with golden stars, lures the unwary. Yet, knowing the tricks, biased survivor pools, meaningless accolades, unveils the hustle. The game isn't about your gain, but their profit. Legends and limits. True outliers exist. Titans like Victor Grayson, who's averaged 22% yearly for 4 decades, or Elena Torres, with 29% over 13 years. A university endowment chief, Samuel Klein, clocks 16% across 23. Their prowess is undeniable, but their feats don't translate to the average soul. Their edge lies in elite tools and exclusive corridors, doors barred to most. Grayson's army of analysts and Klein's private ventures dwarf the lone investors' evening tinkering. Mastery at their level is a rare alchemy, not a blueprint. Crafting a flawless facade. Probability, not skill, often crowns the gifted. Picture a charlatan emailing 10,000 prospects. Half hear StockX rises, half bet on Y. When X climbs by chance, he crows to its believers, splitting them again. 2,500 for Z, 2,500 for W. Each win whittles the pool, until a handful marvel at his streak. Luck, not genius, builds the myth. So it goes with funds. A few shine by happenstance, peddling their secret to the credulous. Do you need a guide? The chorus persists. I'm too busy. Can't an advisor handle this? Life's chores, car washes, laundry, get outsourced, so why not money? For most, though, The need is overstated. A few hours spread over weeks can craft a self-running system. Advisors, meanwhile, aren't bound to prioritize you. Some counsel wisely, many peddle costly wares for their own cut. Fee-only planners offer clarity, but returns rarely justify the expense. DIY investing, with low-cost index funds, often wins. For less complex cases, inheritances, tangled portfolios may warrant help. Better a fee paid than paralysis. But lean on crutches too long, and the cost mounts. A 24-year-old, Sarah Lynn, ditched her planner after 4 years of flat gains and 1.5% fees, seizing control via an online account. The shift paid off. The passive advantage. Investing isn't futile. Only misdirected faith is. Mutual funds, bundles of stocks, promises but falter under active management. Hand-picked by humans, they chase elusive gems, only to stumble. Selling rashly. Trading excessively. Fees, 1.5% to 3% yearly. Gouge returns, plus loads that nick purchases or sales. A $10,000 pot at 2% bleeds $200 annually, win or lose. Contrast this with index funds, cousins run by algorithms. They mirror benchmarks like the S&P 500, aiming not to dazzle, but to match. No costly staff, just code. Fees dip as low as 0.18%. Markets dip, they dip. Markets climb, they rise. Over decades, an 8% average endures. Active funds flare briefly, 70% in a banner year, but consistency eludes them. Ask their 10-year net returns, and evasions flow. Index funds, lean and steady. Edge ahead, the myth crumbles. Expertise is no golden ticket. What follows is the how. To invest simply, sidestepping the clamor and claiming what's yours. The tools await.